The Congressional Budget Office, CBO, the nominally nonpartisan and impartial umpire of U.S. fiscal policy, released its latest long-term projections in March. The numbers convey what is essentially an open secret in Washington, that U.S. finances are on a wholly unsustainable track. Yet the extent of the fiscal pressures, which stem from rapid growth in interest payments and mandatory spending, and the immediacy with which they will begin to be felt, make for some sobering reading. Simply put, the problem of tomorrow is becoming the crisis of today, and this will resonate in onerous fiscal constraints in U.S. politics in the coming years, with variables like interest rates and economic growth amplifying or easing the pressure. At best, the nature of U.S. politics will change. At worst, a crisis of faith will shake the foundations of global finance, fracturing the pillars of the post-Cold War global order. What a difference 15 years can make. In 2008, U.S. public debt stood at 39% of GDP. Now that number is hovering around 100%, buoyed by the combined fiscal pressures of the Great Recession and the COVID-19 pandemic. The CBO's long-term estimates from 2024 onward point the way to ever greater heights, with the debt projected to hit 166% of GDP by 2054. Debt growth will be fueled by ballooning overall deficits, despite primary deficits, pre-interest spending, expected to remain either unchanged or smaller relative to GDP over time. In other words, deficits are on a destabilizing track regardless of how the discretionary budget is handled, driven by a locked-in expansion in mandatory spending and debt servicing costs. The included charts illustrate that the U.S. government has been spending beyond its means and, barring a major course correction, will soon face unprecedented fiscal pressure from ballooning interest payments. Such payments have already doubled in just a few years, jumping from 1.5% of GDP in 2021 to 3.1% in 2024. In absolute terms, going by the CBO's 2024 GDP numbers, this translates into an additional $426 billion in annual outlays. The current fiscal year thus marks a turning point where the cost of debt servicing actually might exceed the entire defense budget of the United States. And it only gets worse from here. By 2034, the U.S. government will be paying $1.6 trillion annually in interest, and interest payments will account for 64% of the deficit. And by 2050, annual interest payments will reach $4.2 trillion, according to the CBO's economic baselines. This dire fiscal outlook ensures that future governments will be forced to borrow to cover previous debt obligations. Not only is this economically wasteful since no new productive capacity is being created, but it involves considerable fiscal risk, especially given the extent of the public debt. The overriding takeaway is that U.S. fiscal stability will become inexorably tied to the functioning and goodwill of debt markets. Interest rate fluctuations in particular will reverberate in hundreds of billions worth of payments added or subtracted. This all places a spotlight on the CBO's take on future interest rates, which will go far in determining the ultimate accuracy of its long-term predictions. According to the CBO, the average interest rate will be an approximate 4.2% from 2024 to 2054. This benchmark underpins many of the alarming aspects of the CBO's projections: the growth in deficits, public debt, interest outlays, etc. Some might view the interest rate as an overestimate, arguing that the post-2008 period of historically low interest rates is less an anomaly and more a new normal going forward. Others, notably the CBO itself, have maintained that interest rates will eventually move back toward their historical averages, especially as the fiscal effects of higher debt loads begin to sink in. These differing views on the future direction of U.S. interest rates go a long way in determining the perceived severity of Washington's fiscal outlook going forward. The higher the rate, the higher the risk. One of the significant trends highlighted in the CBO projections is the consistent decline in discretionary spending, falling from 6.4% of GDP in 2024 to a mere 4.9% of GDP in 2054. This contraction of the discretionary budget is largely due to the expansion of other outlays, primarily interest payments and mandatory spending. The projections, if they materialize, would be a remarkable deviation from the recent past, where discretionary spending averaged 7.3% of GDP from 2003 to 2022. The elevation in interest payments and mandatory spending, especially on major health programs like Medicare and Social Security, is pushing discretionary spending to the periphery. The forecast for 2054 depicts Medicare's share swelling from 5.6% to 8.3% of GDP and Social Security spending growing from 5.2% to 5.9% of GDP. This indicates a shift in spending priorities, often leaving discretionary spending as the first target for lawmakers wanting to rein in the government's fiscal deficit. By 2030, the projections predict a further decrease in discretionary spending, falling to 5.4% of GDP. The constricting discretionary budget could have far-reaching implications on the health of the US economy. It encompasses programs that fuel everything from scientific research and transportation to education and welfare, accounting for $917 billion of the total $1.7 trillion discretionary outlays in 2023. The other element of the discretionary budget that could have a global impact is defense spending, with an allocation of $805 billion, comfortably outpacing China's military expenditure. However, the CBO projections imply that maintaining these spending levels relative to GDP could become untenable without a significant recalibration in the near future. In summary, the rising tide of interest payments and mandatory spending is squeezing discretionary spending, limiting the fiscal space lawmakers have to maneuver. This tightening could have enduring effects on the US economy, restricting its ability to invest in areas crucial for long-term development and global influence. The latest long-term CBO projections have generated a lot of buzz in media and policy circles, and rightfully so, given the fiscal challenges on the near horizon. A consensus seems to be emerging, albeit slowly, that the status quo is unsustainable, and this could prompt action from the US government. However, the current polarized state of US politics is hardly conducive to bold and concerted policy, and many of the major props in this fiscal drama, Medicare, Social Security, the defense budget, are career killers for the reform-minded politician. Thus, it remains likely that policy change will unfold reactively rather than proactively, and possibly in the context of a wider fiscal crisis. We've seen such crises before, with one recent example being Greece in 2009, which the country has yet to full recovery from in GDP terms. Yet the United States is far more important to the global economy than Greece by many orders of magnitude. There really can be no comparison, because a fiscal crisis in the United States has the potential to fundamentally rewire the circuits of global economic and military power. The CBO's report notes that the short-term probability of a crisis is low because risk is mitigated by certain characteristics of the U.S. financial system that sustain demand for U.S. treasuries, namely the Fed's independent monetary policy, the fact that U.S. treasuries are USD denominated in a global trading system that runs on the greenback, and the perceived safety of treasuries as an investment. Taken together, these factors delineate the exceptional status that the U.S. government enjoys when tapping into debt markets. When the U.S. government looks to borrow, there's no shortage of parties willing to lend, from states looking to shore up their foreign exchange reserves to institutional investors looking to rebalance their portfolio. As an instrument of global finance, the U.S. Treasury is without peer in terms of liquidity, and with most commodities priced in US dollars, treasuries are basically the fuel that global trade runs on. This desirability and demand for treasuries translates into favorable financing conditions for the US government, but only to a point. This is the inflection point where US finances veer into crisis, and its precise location remains unknown. We do know that we're not there yet, not even close, as the market was able to absorb record debt issuance in 2023 without upward pressure on yields. However, higher for longer inflation threatens to dampen future demand, as buyers will no longer be trying to get in ahead of an expected easing cycle. What's more, against the backdrop of this seemingly healthy treasury market, Fitch downgraded long-term US debt from AAA to AA, plus in August of 2023, citing an erosion of governance and government inaction in the face of mounting fiscal challenges. Ultimately, Treasury demand will remain a matter of faith. So long as the Treasury retains its utility as a convertible and safe pillar of global finance, US debt will continue to be financed at highly favorable rates. Yet the 2022 Liz Truss affair in the United Kingdom serves as a stark reminder of just how quickly long-held perceptions can change. Truss's record-brief premiership was tanked by bond markets responding to her attempt to institute £45 billion worth of unfunded tax cuts. The episode saw the pound sterling drop to record lows against the US dollar and eventually forced a total policy reversal as the offending mini-budget was thrown out. In this case, government policy was determined by what the markets were willing to bear, and there's no reason to believe that the United States will permanently retain its exceptional status in this regard, especially in a high interest rate environment where new debt is paying for old debt. Moreover, given the importance of the Treasury to global finance and the lack of any viable near-term replacement to the US dollar as a global reserve currency, this hypothetical inflection point won't come easy. Rather, it's more likely to emerge only in the event of a crisis, thus narrowing the available policy options at the time and prolonging the economic pain to follow. The rules-based international order is sustained by US military power, which in theory guarantees the free passage of goods that underpins global capitalism. In more concrete terms, this military power is exercised via a blue water navy, a network of global military bases, and a constellation of bilateral and multilateral alliances that ensure the stability required for global commerce, particularly with regard to the free flow of fossil fuels. This alone requires significant financial commitments to sustain. But then there's also the supplemental and exceptional military aid packages that Washington provides to strategic or friendly states. Consider the recent passage of a $95 billion aid package to Ukraine, Israel, and Taiwan. If this package were itself a state, it would fall between Russia and India as the fourth largest military spender in the world. These outlays come at considerable cost to the US taxpayer, and they are intended to secure certain imperatives of US power, whether it be containing a potential adversary or maintaining a permanent foothold in a strategic region. Yet, as discretionary budgets are squeezed, this kind of spending will inevitably become more politicized, as the policy trade-offs come into sharper relief, with voters diverging over domestic and external spending priorities. An isolationist trend is already discernible in the post-Trump Republic base, and these voices can be expected to grow louder and cross partisan lines as the perceived fiscal costs of US global power projection grow. Where exactly this leaves the global order is impossible to predict, but it's safe to say that the direction and velocity of US military spending will send ripples through the system. In Ukraine, a delay in military aid translated into battlefield gains for Russia, which will in turn influence the timing and character of an eventual agreement. In Taiwan, the peaceful status quo is sustained in large part by Beijing's calculations of the extent of US military support in the event of a war. And Israel's entire domestic and foreign policy outlook might look radically different in the absence of US aid and military support. 3 conflicts in 3 regions. In all of them, US military spending exerts a determining influence. This is not to suggest that the global system would be better or worse off without a globally minded US military, only that it could be fundamentally different. Here it's also worth emphasizing that, unlike in the case of other collapses of the global system, WY, interwar years, decolonization, this time the challengers also have something to lose. Strategic competitors like China actually have an interest in sustaining the rule-based international order, insofar that it ensures access to the markets and inputs that are essential to its economic development. Thus, it's possible that the multipolarity trumpeted by upstarts like the BRICS bloc may in some ways resemble the status quo given this shared interest in sustaining the unimpeded passage of commodities and capital around the world. Alternately, we could see a regional fracturing of global capitalism as regional powers that lack a blue water military capacity move in to fill the space once occupied by the US military in their respective regions. Divining the state of the US economy 10 years from now is hard enough, let alone in 30 years, and as such, the CBO outlook should be taken with a grain of salt. Variables like interest rates, demographic and political change, and overall economic growth can intervene to derail otherwise impeccable methods. Taking just growth, for example, consider recent black swan events like the 2009 financial crisis and the COVID-19 pandemic, both of which defy any attempt at prediction and continue to reverberate for years, if not decades. There are a few takeaways that can transcend this variance, however. 1. US public finances are on a wholly unsustainable track. 2. Reliance on debt markets opens the door to a crisis in the medium term. And 3. Mounting fiscal pressures have the potential to reorient political priorities within the United States, particularly with regard to defense spending. The combined effects of these forces are not inconsequential, and in extremis could bring about a fundamental overhaul of the post-Cold War global order.